Hi there, ladies and gentlemen. It's James Marley here, co-founder at Livewire Markets, and you're in for a treat. We're having a Views from the Top deep dive interview with Dr. Philip Hofflin, analyst and portfolio manager in the Lazard Australian equity team. Philip, great to have you back on Livewire, and thanks so much for your time.
Always a pleasure to be here, James.
Now, we're going to be covering a range of topics from the bigger picture in markets, some of the sector and concentration, drivers of the Australian market. We're going to find out what's exciting, where you see value, given you are a value investor. But let's start off with the bigger picture in the backdrop. We're in this environment of low and slowing growth, and there is an expectation that interest rates are going to be falling in Australia next year, I guess is where we're at the moment. What are some of the implications that you think investors need to be aware of that setup?
Look, the obvious consequence, James, is that we've had earnings, EPS for the market in aggregate fall in 23. It fell in 24. It's expected to fall in 25 because we've come off those COVID highs. And when it comes to sectors, again, it's pretty straightforward. We all know that retail's been a bit soft. Housing is downright weak, as you'd be aware. But then there have been lots of other impacts on the market from this, particularly from this inflation burst. So, for example, a lot of healthcare players in Australia have done really badly, and that you'd think are very defensive. But they've been caught by a squeeze between sort of government-linked or government-mandated revenues and the cost pressures from below. So I'm thinking here about things like hospitals, pathology operators, for example. So this downturn isn't new. It's reasonably well priced. We know about the softness. But if things turn down more, for example, some of the aforementioned sectors will continue to be weak, but it's great news, for instance, for these healthcare stocks, because they want inflation to subside and the cost pressures to go away. So there are lots of nuances, amongst different sectors. When it comes to rates, I think the expectation that it will generally come down is probably correct, although I think just last week we had Jamie Dimon from JP Morgan and Ray Dalio saying, I think they're all on the way up in the medium term. We'll find out. I think it's fair to say, though, that if we don't get a big downturn here, then I think they will stay much higher than perhaps we originally anticipated, and we'll be at a higher long-run level. When it comes to the macro questions, James, look, we're pretty agnostic because we like to focus on stocks. So we tend to stay away from that. The only last thing I would probably say is that those who expect that we get rate cuts, it's 2021 again, and the froth is back and so forth, I think they may be disappointed simply because there's very little correlation between multiples and interest rates unless they get extreme. And we've seen plenty of bubbles inflate on high rates, like the Nasdaq bubble in 2020 or the Japanese bubble, and then deflate as rates were cut. So I don't think that's a sure guide. And multiples in generally tend to be pretty high already. So we shouldn't expect them to really get a lot of boost just because rates come down 100, 200 bips.
I was going to say maybe some of it's already playing out in the market throughout this year.
Most of that. I think a lot of the weakness and the rate cuts are well anticipated.
Let's stay just around this particular backdrop, let's call it slowing growth and stable to slightly lowering interest rates. But are there specific sectors or types of companies that you think look more attractive against the backdrop that they're moving into for 2025?
I've got to say there, in some ways, if you tell me, James, what's going to happen, I could tell you who's going to do well or badly. Defensive, cyclical, interest rate sensitive stocks like computer share and insurers and banks and so forth versus others. But as I look, this downturn and the rate cuts are very well anticipated. So it really has to be a divergence from that will move markets. So I don't think I can add that much to that question at the moment. And we'll just have to, as we very often have to do, see and wait what happens, because these things are very hard to forecast.
Play it as it comes. So what role does the economic backdrop play in Lazard's investment process versus just looking at company valuations and fundamentals?
To us, all these things you just mentioned are really one and the same thing, because there's the company, the model, and the valuation, and that requires some factors that are macro inputs. So let me explain to you how we do this. Philosophy is this, that we know something about what's happening today, and we might have some view of what's happening next half year, whatever. But we believe that we know really nothing about what the world will look like in 27 or 28, right? And history certainly teaches you that. Boom, bust, what will governments do, what will China do, we don't know. So what we do is we first strike a valuation, if you will, based on a normalized environment for the company. When I say normalized, I mean we normalize everything, micro variables, there might be margins, there might be tax rates, franking rates, everything else. And there'll be macro variables, exchange rates, commodity price and everything else. And we try to come up with a normalized valuation because we think it's on the right side on the averages, right? If you're right in the middle. Now, we also know that there are some things happening today. So we incorporate the short term. There might be a cycle up or down in the short term. And that totality makes up the valuation. So the focus is always on the normalized long run, after taking into account what the short term is going to bring. Mostly that doesn't make a big difference. So let's say for Woolies, it's not going to move the dial in the short term. On the other hand, you may have a very highly indebted company or a high cost producing commodity producer on the commodity prices is through the roof. That makes a big difference, the short term. But the anchor is always back to the long run because we think it puts us on the right side of the averages. And if I'm going to make an analogy here, I don't know whether you're a golfer, but
don't mind a round.
Don't mind a round. Both golf and investing is quite a hard activity. You've got a very small ball to get into that hole. And even a very good golfer, there's a statistical distribution, right? He's going to have a good day and he's going to have a bad day and an unlucky day and an unlucky day. But I want to sort of make an analogy here to the famous statement by Gary Player, who said, the more I practice, the luckier I get. And our view is that if you have a portfolio with lots of modestly valued stocks, with low expectations, the more you have it, the luckier the portfolio gets.
Very good. I like it. Well, let's get into some specifics. Simple question for a value investor. Where are you seeing value as you look towards 2025?
Look, I'm going to answer the opposite question, James. Because the market is really quite expensive. And there have been times when I've come in and seen you and said, thumped the table a bit and said, you need to really look at this. Perhaps you need to be there. Back in 2020, you'll recall. The moment I'm going to say something else, I'm going to thump the table and say, here's where you should not be. This is the wrong place to be. And as people found, let's say over from 21 to 23, what really mattered was where you weren't. What didn't you get caught in?
Yeah.
So I want to talk about two things there. The first one is just simply the boom's back, right? And brought along some data for the viewers here. And what we show there is we show the top and the bottom quintile of forward Ps across the ASX 200 for the last 30 years. So you can see how the market has evolved and how the cycles have come and gone, because to understand what might happen, you need to know where you are in the cycle. And you can see there, early on in 2000, there was this enormous spike in high multiple stocks. That was the dot-com bubble. And then once we went through the GFC, the real sort of boom started sort of in 12, right? So the market was beginning to warm up again after a horrific episode. And you can see there that from 2012 to 21, the high multiple stocks had their forward multiples triple, more than triple. So what that means is these stocks went up threefold, even if the PEPS was flat. That's what it means. EPS, the P tripled. And because it all ended up in that huge frenzy, COVID, SPACs and crypto and who knows what, and free money and checks to households. And that was that bubble in 21 where the forward multiple got to 57 times, Australian record. And then things started to normalize over 21, 22 in particular, into 23. But then, rather surprisingly perhaps, it reversed. And that was, of course, the AI boom in the United States. And that has once more emboldened people to pay high multiples. Now, it's unclear why you should pay a high multiple for a Mexican fast food chain just because it's an AI boom, but that's another question that's above me. But the multiples are back, and we're at 47 times again, and it means that we're higher even than March 2000, which is really quite saying something. And we've seen echo booms in the past. There was 72 following on 69, for example. And while it's made for a worse year for us, there's also a real opportunity here because we talked to quite a few people who, during that long boom from 12 to 21, they unintentionally end up very overweight growth equities because they were doing so well through this multiple inflation. And then they had a really difficult period for those 2 years from late 21 to mid 23 because they had an unintended bias in their mix. Yep. And this is in some ways, this is a second bite of the cherry. This is a second chance to eliminate that bias if it's there at really good prices. And on a forward basis, it's now a much better time for value again because the market is more distorted. Now, I just want to briefly say something about the AI phenomenon because it is very real, it's a big thing, but its application in Australia is, of course, very indirect in the sense we have no AI companies, we have no hyperscalers, we have no Magnificent Seven. This is just a license to have higher multiples for stocks unrelated to AI in most cases. But I want to go even a bit further and say that, because I'm very interested in the AI question and the technicalities of it, that if AI is modestly successful, this is probably good for some of our software companies. We've got some very highly valued and very successful software companies. If AI is very successful, James, it's an absolute disaster potentially. Because if you think of the typical good company in Australia, without mentioning any names, they have popular software, it's user-friendly, companies like using it, their workforce like using it, so you have a moat,
Yeah.
And that's all wonderful. And if AI is just a tool you're going to put into that, that's great. Everybody will do that, and that doesn't change much. If AI is very successful, and some of these stocks trade on 50, 60, 70 times, so you're looking out a long way. If in the next 10 years it is very successful, then these companies will disappear. Because you're going to replace the white-collar workforce and the software in one hit with an AI. AI will be your workforce and your software in one hit. Nothing user-friendly is required. The AI does the job all itself. And there was this quote by Mark Andreessen in 2011 when he said, software will eat the world, and it's been a great decade for software. But more recently, Jensen Huang from NVIDIA said AI will eat software. And I think that's the scenario is thinking about. This is the one software to rule them all. It will cause enormous disruption in software, and the past winners may not be the new winners, because there's going to be an enormous impact from AI if it is successful.
So the bull case for AI is the bear case for some of the other software players?
In some ways, yes. And look, I've seen this before. I mean, in the tech boom, Fairfax was one of the biggest winners, can you believe it, in the tech boom. Stock doubled on the TMT thematic. And it turns out it was one of the biggest losers out of the internet on the stock exchange. So sometimes the market even gets the direction wrong. So I would just say that on software, there's potentially a lot of disruption ahead, and you don't really want that when you have a nice profitable niche that might disappear.
Okay. Well, I can see you're very passionate about the AI story, Philip. We're going to bring you back to earth with a bit of Australian large cap dominance, which is banks and resources, which still make up a massive part of the ASX 200. But we have seen a divergence in their fortunes. What have you made of the recent divergence in the fortunes? Longer term trend has favoured banks over resources, but recently a bit of a rotation. What's your take on the play there?
In some ways, this is anticipating the second point I was going to make, things you perhaps should be aware of. And the banks are very expensive. So let me sort of dimension that for you a little bit, James. Our last 18 months, the forward EPS has gone up by 5%, and the prices are up 45%. It's inevitable from that. The PE has gone up a lot. And how much has it gone up? Well, it's reached on 20th September particularly, before the big turn came recently, they reached the highest PE in 50 years, which is as far as we can tell, right? So very high. The sector overall 20 times, Combank in particular 24 times forward. So, last time I checked, Jeffrey's global database of all listed banks, emerging market and developed and whatever, it was literally the most highly priced bank on the planet. And it was the 6th largest. So a little bank might have some reasons why it looks expensive, but it was then capped as the 6th largest. And moreover, it was on twice the multiple of JP Morgan. JP Morgan on 12 times, Combank on 24 times. JP Morgan has a higher ROE and much better growth prospects because it's still very small. In that huge US market. Now, why has this happened? It's a really good question, James, because it seems to be this idea that there is this binary choice in Australia. You either buy BHP or Combank, and if you don't like BHP, you have to buy Combank and vice versa. It doesn't make a lot of sense in the sense that, fundamentally speaking, of course, yes, weak news from China is bad for resources, but it's also, to a lesser extent, bad for banks because it's Australia, right? So it would make sense if resources fell more and banks fell less, but it doesn't explain a huge rally in bank shares because there's bad news for Australia. And after the 20th of September, when there were some positive noises out of China, you saw this dramatic reversal, and everybody ran the other way. And again, I mean, on the face of it, what we're saying is here that Combank fell $10 in a week because there was good news from China. Now, good news from China is good for Combank. Right? It's good for Australia. It's good for terms of trade, for taxes, for everything. So there's a strange dynamic going on that I don't pretend to entirely understand because there is another 50% of the market. You don't have to buy both. And in fact, we are underweight both.
So it's about flows of money.
It seems to be flows of money. I think that's the best explanation I've heard. It's money moving from active to passive and various things like that. But it's not underlying valuation.
Okay, let's just stay there. How are you allocating across banks and resources in your portfolio?
Look, I'm not going to surprise you here, James. We started underweight both. In the banks, we've gone more and more underweight as this rally over the year unfolded. And again, I'm referring to the 20th of September. Our select fund was by that stage 18% under the index. It's a huge number, but we're pretty confident the prices are way too high. Amazing enough, James, it's not the highest it's ever been. Can you believe it? In May 2015, which was the all-time high for our banking sector, they were 33% of the index. We were 25% underweight. So not quite as extreme as that. And then suddenly turned, and suddenly we're now down to 15, 16% underweight. But that was just the bank prices falling. On the other side of that, resources, we started the period again underweight, and we stayed pretty much there. In the last quarter, in the September quarter, we started adding a couple of names in the mining sector to the portfolio, but we're still underweight even now.
We talked about the concentration of these big sectors. What are some of the ways that you overcome the high level of concentration in the ASX 200? How do you deal with it?
Look, I mean, apart from that first point, it's not a binary choice, right? There are lots of other stocks out there. Yeah. The second thing I'd say, look, our market is, concentration in markets depend on two things: the size of the exchange and the diversity of your economy. So there are two exchanges in our region that have very similar market cap to the ASX. That's the Taiwanese market, which is even more concentrated than ours. And there's the Indian market, which is much more diversified than ours. So we're not unusual in that sense, compared to similar sized markets in the region. Now, we don't actively go out and say we're going to do something about that, but in effect we do, because we like to invest in stocks on the opportunity. The size has nothing to do whether they're good investment or not. So if you think of the top 100, the ASX 100, right? All of these stocks are pretty big, and you can actually buy reasonable chunks in them. They've got that size and liquidity. But just naturally, by chance, 80% of the opportunities will come outside the top 20. It's the other next 80 stocks, right? And only 20% of the opportunities on average will come from the top 20. So we are always overweight the mid caps because of that, which also diversifies your portfolio much better than just being sort of caught by you have to have a lot in just one sector and so forth. And at the moment it's a bit more extreme because of the banks are so expensive. At other times we've been index weight in the banks, right? We're not. And in the long run, we don't mind that, in the sense that if there's any evidence between very large caps and smaller companies, it's that, and this makes perfect sense if you think about it, the smaller caps tend to grow a bit faster, right? Because the large caps do include some very mature businesses that have grown very large, but they're now limited in what they can do from here. So it's not in the long run, it's not a bias that worries us, but we're normally overweight the mid caps.
You talked about a big underweight position in the banks, underweight growing position in resources. I'm going to push you for an idea or two just in that mid-cap space. Is there something that you do have some conviction around?
Look, yeah, I mean, if I mention some of the names we own, we are in nickel industries, in the metal space.
Yep.
It's an interesting company in the sense that you'd be aware that there's been this absolute disaster on the Australian nickel industry. Most of them are closing or have closed or whatever. And that's because of the enormous supply increase at the bottom end of the cost curve out of Indonesia. And the Indonesians have done this. Well, in some ways the Indonesians haven't done this. The Chinese have done this. They've invested $35 billion in Sulawesi. And they've pioneered a new industrial process for producing high-grade nickel from resources that in the past were thought low-grade and not suitable for that. And the great thing about nickel industries, it's in Indonesia with Tsingshan, the Chinese, co-investing with them. And it's a stock that has all sorts of ESG angles. So I should tell you that we value this thing on a 20% discount rate. Can you believe it? Because it needs to be harshly treated. But it's a very good operation. The partners they work with, the projects are delivered on budget, and they start at above nameplate capacity immediately. And it's been a very slick operation. And they are the disruptors, so we quite like that. We've recently added a bit of, we left South 32 when the price was higher, but we've added a little bit South 32 back in the portfolio. And we've taken a very small stake in a met coal miner, Coronado, basically on the expectation that they've had a period where their costs have been too high because of the mine plan, and their costs are going to drop. And we're reasonably positive about this because it is in part linked to steel, of course, and iron ore. But if you think of the future in India is going to be particularly reliant on met coal exports rather than iron ore. They actually have some decent iron ore in India. While they will also need iron ore from us, the big opportunity eventually will be India, but that's a little bit further out.
Probably a good point for us to talk about China, given off the back of a few of those resources names. But China has been looking to inject some stimulus into a bit of a faltering economy. Do you think it will work, or do you think it's a bit of a last-ditch effort?
Look, I think it is very much a question of will. And I should answer the question by saying I'm not a China expert, and China is incredibly opaque. Remember, for a while there, Australia did not have a single foreign correspondent in China. I think there are now 1 or 2 back. Very opaque. And what the Chinese say and what they do, sometimes they're the one and the same thing, and other times they're not. So you've got to be very careful there. I think fair to say that internally, one of their aims is to delever their corporate sector. Their corporate sector has outrageous amounts of debt, so that's a worthy aim. So that monetary stimulus, that announcement from the People's Bank of China after the 20th that got everybody excited, that's not really the long run future. I mean, just having companies take on more debt yet again to spend, I don't think that's really what the way to do it, and it's not what China wants to do. I don't think it's what those companies want. And as Japan demonstrated, if companies want to delever, well, they're going to delever, right? And you can offer them 0 rates, it doesn't make much difference. The other thing is, though, that that deflation in the property sector and the redirection of that capital into high-end manufacturing, that is a policy aim of the leadership. So again, I don't think they're going to diverge that much from that. All that suggests that the way to do it would be stimulus for households, right? Because you're not relying on more debt. You just try to get the savings rate of the household sector down a bit and get them spending a bit. It's a very large sector. Now, all really comes down to one man, right? And I don't think we should necessarily expect President Xi to act the way a Western politician does. He may, or he may not. So I think that's really what we're facing. It is very hard to tell. They haven't put the money on the table yet. There's a lot of noise and stories again and again. There's another briefing coming up and so forth, and perhaps they will. And they did it in 2015, and they did it in 2009, of course, 2008-9, of course, in dramatic fashion. So they can, James, they can. But will they?
We're going to stay. One more question on the resources theme, and
Yeah.
I think this is really interesting. One of the big deals in the market, Rio Tinto recently made a $9 billion bid for Allocating, a lithium company. Do you think this is a good use of capital for Rio shareholders?
Look, we're Rio holders, but I've got to say to you that on our numbers, it's a bit dilutive. Now, the acquisition is 6% of Rio, right? Let's say they overpay 10%. That's 0.6%.
It's a pretty small fry.
That's a daily move, right? You don't even notice that. So it's not a big, it doesn't move the dial. I've got to explain, though, that we do have in 24, this year, we bought our first lithium exposure. We're in IGO, which has a much superior model because remember, they're in Greenbushes. They have by far the lowest cost in Australia, yeah. So and a very good balance sheet. They've cash sitting around. But we do have very conservative lithium prices. We have only a bit more than $1,000 for spot per tonne, which is very low. And we do this because we just don't have the same confidence in the cost curves that we do, let's say, have for zinc or nickel or copper, because they're well established. Lithium is very complex. There are different mining methods. The brine players are much cheaper, for example, and so forth. So we like to take a big discount, and that's one of the reasons why we think it looks a bit expensive to us. It does have good assets in the sense that it has some very low-cost brine assets in Argentina, some of the lowest in the world, so it's tier 1, as you'd expect Rio to do. It has refineries in the US and China. And I think one of the stories is also that Rio may be attracted by the direct lithium extraction DLE technology that Allocating has in South America, which people say may be better than Rio's. And they think, we can scale this, we're a big guy, and let's get our hands on this better technology and do it that way. So overall, I'd say, look, it's a contrarian, anti-cyclical investment in a commodity that's really down and out, but it doesn't add any value on our numbers.
Well, Philip, thank you so much for coming today. I always enjoy having our catch up. I also enjoy hearing you banging the table, not necessarily because you're finding compelling value, but letting people know that you're cautious out there as well. So appreciate you being open about that. Ladies and gentlemen, I hope you enjoyed that catch up with Dr. Philip Hofflin, Portfolio Manager and Analyst at the Lazard Australian Equity Team. Remember, check into our YouTube channel. We're adding fresh content just like this every week.